Welcome back to Talk Tickers. This is the show for the institutional mindset.
Absolutely.
If you are tuning in, it is because you are done with the noise. You are done with those 30-second cable news sound bites that really tell you nothing at all about the underlying mechanics of a business.
Right, the ones that just read the top line and move on.
Exactly. We are here to cut through the noise of earnings season. We do not just read press releases to you. You can do that yourself.
I mean, hopefully you're doing that yourself if you're managing capital.
Yeah, exactly. But we were here to look at the prints that actually move the needle, the ones that shift the narrative. And today we are looking at a print that left the market completely scratching its head. I'm your host, and today we are doing a deep dive into a company that has been a total battleground stock for honestly the better part of a decade.
It really has been.
We are talking about Wayfair, ticker symbol W.
The online furniture giant, or I guess as we might be calling them after this quarter, the online and offline furniture giant.
Yeah, we will definitely get into that retail pivot later because that is fascinating. But right now we are breaking down their Q4 2025 earnings call. And frankly, well, it's just a fascinating morning to watch the tape.
Fascinating is one word for it. Volatile is probably a better one. Or maybe just violent.
Violent is the word. It was one of those mornings where you look at the press release, you see some of the headline beats, and then you look at the stock price, and you actually have to rub your eyes to make sure your terminal isn't broken.
Yeah, you think there's a glitch in the feed.
Exactly. So let us address the elephant in the room right out of the gate here. The price action. The market absolutely hated this print. I mean, they viscerally hated it.
They puked it.
They really did. We saw the stock drop roughly 13%. 13% in a single session. We went from trading pretty comfortably around $91 down to the high 70s, eventually settling somewhere around $79.
And it is so important to point out that this was not just some, passive drift lower.
Right.
This wasn't low volume retail capitulation where a few day traders get spooked. This was high conviction institutional selling.
The volume was insane.
It was. We saw volume hit 11.5 million shares traded. For context, if you look at the average daily volume, Wayfair typically trades somewhere between 3 to 5 million shares a day.
So you had basically triple the normal activity.
Triple the activity, and almost all of it was hitting the bid. When you see that kind of aggressive volume on a gap down, it tells you clearly that the institutional crowd, the pension funds, the hedge funds, the long-only asset managers, they're entirely repricing the risk on this equity.
It is a classic setup, though, isn't it? I was looking at the actual numbers this morning, and it felt like I was reading two completely different reports at the same time.
The two sets of books.
Yes, the classic two sets of books quarter. Because on one hand, you have management, specifically the CEO, Niraj Shah, and CFO, Kate Gulliver. And they are practically popping champagne corks on the conference call.
They sounded very confident.
Extremely confident. They are talking about doubling EBITDA. They are highlighting massive market share gains. They keep using the word compounding to describe the business.
Right. If you only read their slide deck and ignored the tape, you would assume the stock was up 15% today.
100%. But then you look at the other hand, the actual market reaction, and the street is dumping the stock because of the GAAP numbers and the margin guidance. So help us frame this right off the bat. Why is there such a massive disconnect between management's victory lap and the market's panic?
It all comes down to the cost of growth.
Okay.
Think about the narrative for Wayfair of the last, say, 18 months. It has been strictly a turnaround story.
You're getting lean.
Exactly. It was all about efficiency, cutting the fat, showing the market that this business model can actually generate cash. But with this Q4 print, that narrative shifted abruptly. It shifted from turnaround to expensive growth.
Expensive growth.
Yes.
That is a phrase that completely terrifies investors in this specific macro environment.
And it absolutely should. What management is signaling here is that they are going to spend money, and specifically, they are going to spend gross margin dollars to capture market share.
Right.
And you have to put yourself in the shoes of an investor today. We are in a macro environment that is still incredibly jittery about consumer spending and interest rates. So investors looked at that strategy of spending margin to get growth, and they punish the uncertainty.
They hear the word investment from management, and their brains immediately translate that to margin compression.
They translate it to margin degradation. They translate it to a price war.
Okay, let's unpack the actual results snapshot, because this whole headline beat versus the miss dynamic is where the story gets really complicated. Let's start with the top line.
Let's do it.
Revenue came in at $3.34 billion. That is up 6.9% year over year. And consensus was looking for $3.30 billion. So objectively, that is a solid beat.
It is a solid beat. But you really have to look at the context here to appreciate what that top line means. You cannot evaluate that near 7% growth in a vacuum.
Because of the category.
Because of the category. The home furnishings category as a whole is not booming. It is doing the opposite. Management explicitly stated on the call that the overall category is contracting in the low single digits.
So the total pie is actually getting smaller?
The pie is shrinking. People are just not buying furniture like they were during the pandemic boom in 2021. So if the tide is going out for the whole industry and your revenue is somehow going up almost 7%, that is the literal definition of taking market share.
They're eating someone else's lunch.
Exactly. They are taking share from the fragmented players. And actually, if you strip out the Germany exit, because remember they strategically left the German market recently to focus on their core profitable regions, if you strip that drag out, the growth is actually 7.8%. So the top line engine is clearly working. People are still buying furniture from Wayfair, even if they're pulling back from other retailers.
And the adjusted profitability looks pretty fantastic, too, if we just stay on the good news for a second.
It does.
Adjusted EBITDA came in at $224 million. That is a 6.7% margin. Just to put that into perspective for you listening, that is double the dollar amount they generated in Q4 of last year.
Right.
Double the EBITDA. If you just stopped reading the report right there, you would think the stock is flying.
But we didn't stop reading there.
No.
And neither did the algorithms or the analysts. We have to talk about the ugly number, the GAAP reality.
Yeah, the GAAP earnings per share. This is where the wheels completely fell off the bus for the bulls today. The street consensus was looking for a positive GAAP EPS, just barely positive. They were looking for plus 1 cent.
Just barely in the black.
Right, just crossing the line into profitability. But instead, Wayfair printed a loss of negative 89 cents per share.
That is a massive delta.
It is huge. They missed by 90 cents on the bottom line. That is not a rounding error in accounting. That is we need to have a serious internal meeting kind of error.
It really is a huge miss. And look, when you see a discrepancy that wide between adjusted earnings, which management loves to tout, and GAAP earnings, which is the actual accounting reality, it forces any seasoned investor to ask a very pointed question.
What are they adjusting out?
Exactly. What magic wand are they waving on the income statement to turn a massive GAAP loss into a beautiful adjusted profit?
Right, because that gap, no pun intended, that gap represents real economic friction, real costs.
It represents real cash or equity leaving the business. And this quarter, there were two huge things in that gap.
Walk us through them.
First, you have stock-based compensation, equity-based comp.
Always a big one for tech.
Always. And Wayfair operates a lot like a tech company in how they pay their engineers and executives. That is a real cost to you as a shareholder because it dilutes your ownership. But the second one, and this was the real kicker this quarter that caught people off guard, was a $165 million loss tied specifically to debt repurchase.
Okay, let's pause right there. Debt repurchase. Because usually when a company pays off its debt early, the market cheers. That is normally a sign of financial health. So why did this specific move cause a $165 million loss?
Because of the type of debt they were buying back. They were repurchasing convertible notes.
Ah, okay.
And these specific notes were likely trading at a premium to their face value or their book value. This happens because of interest rate movements or how the underlying stock price has fluctuated since they issued the debt. So to retire that debt early and get it off the books, Wayfair actually had to pay more cash to the bondholders than the debt was listed for on their balance sheet.
Okay, so they paid a premium to clear the deck.
Precisely. And in accounting terms, that difference, the premium they paid to retire the debt early, that has to show up immediately as a loss on the income statement.
So a sophisticated long-term investor might look at that and say, well, the debt extinguishment cost is a one-off item. It is actually a good thing long-term because it cleans up the capital structure, it removes future dilution risk, and it lowers future interest payments.
Yes, a rational long-term thinker would say that. But the market today did not give them a pass.
Not at all.
And that is because when you combine those heavy debt retirement costs with the ongoing heavy stock-based comp, investors just look at the bottom line and see a sea of red ink.
Despite all the management talk about adjusted profitability.
Right, because in a high interest rate environment like the one we are in right now, Patience for adjusted metrics wears incredibly thin. Investors are demanding to see real, unadjusted net income. They want to see the business actually making hard money after paying all the employees with stock and after managing the debt burden. And Wayfair is just not there yet.
Okay, let's pivot and look at some of the operational metrics, because honestly, there was a mixed bag in there too.
Very mixed.
For example, free cash flow was actually positive. They generated $145 million in free cash flow, which is up 40% year over year. That is a very healthy signal that tells you the underlying core business does generate cash.
It does.
But then you look at the customer count. Active customers actually ticked down. They were down 0.5% year over year to 21.3 million.
And that is a critical nuance you have to catch.
Right.
The customer base itself isn't growing wildly. They are not flooding the top of the funnel with millions of brand new people who have never shopped there before. However, if you look at the actual orders delivered, that metric was up 3.7%.
So they have slightly fewer people, but the people who are there are buying more stuff.
Exactly. The people who are inside the Wayfair ecosystem are ordering more frequently. And not only that, but the average order value, the AOV, actually went up. It hit $301 versus $290 last year.
Which is interesting because furniture is basically deflationary right now.
Right, which tells us that the core Wayfair customer is becoming much more sticky, and they are trusting Wayfair with bigger, more expensive purchases. They are buying the massive sectional sofa instead of just buying a desk lamp.
So the loyalty is there for the existing base.
It is. But again, the market completely ignored that efficiency. They ignored the free cash flow. They ignored the fact that revenue beat expectations in a down market. The market focused entirely on the guidance and what they perceived as the poor quality of the earnings.
Okay, we need to dive deep into the financials and that specific guidance because that seems to be the absolute epicenter of the anxiety today.
We were calling this the margin optic problem in our pre-show notes.
It is a massive optic problem. This is where the financial engineering, or I guess the strategic accounting, gets really interesting. Let's talk about gross margin.
So for Q1 of 2026, which is a current quarter, Wayfair guided their gross margin to the low end of the 30 to 31% range.
Now, for a long time, they have been hovering pretty comfortably inside that range and usually pushing toward the higher end of it, right?
Yes, they usually target the higher end to show profitability, but management was very, very explicit on the earnings call. They effectively came out and said, we are actively choosing to spend our gross margin right now in order to capture more customer orders.
Okay, so let me translate that from CFO speak to plain English for a second.
Right.
What they are saying is we are intentionally lowering our prices or we are increasing the perks we give away just to get you to pull the trigger and buy a couch today.
Precisely. And that right there is the major spook factor for the street.
Oh, absolutely.
When an institutional investor hears a management team say investment in price or investment in the customer experience, their brains immediately jump to the worst case scenario.
Which is a price war.
A price war. They think, okay, here comes the margin degradation. They worry that Wayfair is feeling so much pressure from competitors, whether that's Amazon creeping into furniture or specialized offline retailers, that Wayfair is having to discount heavily just to keep that 7% revenue growth alive.
They think the growth is artificial.
Right. They think they are just buying the revenue at the expense of profits.
But to be fair to management, they had a very specific, detailed counter-argument to this exact fear on the call, didn't they? They tried really hard to pivot the analyst conversation entirely away from gross margin and move it towards contribution margin.
They hammered that point home.
So for you listening who might not be building DCF models every day, let's break down the difference between gross margin and contribution margin because it is crucial to understanding Wayfair's entire thesis right now.
It is the most important distinction in this whole earnings report. So gross margin is simple. It is just your revenue minus the cost of goods sold.
So what you sell the couch for minus what you paid the factory for the couch and maybe the freight to get it to the warehouse.
Exactly. It's the raw profit on the physical item itself. Now, contribution margin goes one step further down the income statement. It takes that gross margin dollar amount, and then it subtracts all the variable costs associated with actually selling that specific item to a specific customer.
And for Wayfair, what are those variable costs?
Primarily, it's advertising and outbound shipping. So contribution margin is the actual money left over from a sale after paying for the product, shipping it, and running the Facebook ad to acquire the customer. That leftover money is what pays for the fixed costs of the business, like the corporate headquarters, the tech servers, the salaries.
Okay, so what is Wayfair's core argument here regarding these two margins?
Their argument is that they are executing a strategic bucket shift.
A bucket shift.
Yes, they are saying, look, historically, we used to spend an absolute fortune on performance advertising just to get a customer to click and buy. And that heavy ad spend sits down in the operating expenses section of the P&L.
Right.
What they're doing now is saying, instead of giving millions of dollars to Mark Zuckerberg or Google for ads, we are going to take that exact same pile of money and give it directly to our customer.
Give it to the customer how?
Through their new Wayfair Rewards program, giving them 5% cash back on purchases, or by just slightly lowering the retail price of the items on the site.
Ah, okay. And because discounts and rewards hit the cost of goods sold line, not the operating expense line, the gross margin mathematically has to go down.
Exactly. The gross margin shrinks. But at the exact same time, their ad spend shrinks by an equal amount.
So mathematically, if I as a business save $20 on Facebook ads and I give the customer a $20 discount on the couch, my actual bottom line profit at the end of the day is exactly the same.
Correct. Your contribution margin is identical, and that is what management is screaming from the rooftops right now. They claim that their contribution margin, that profit, after all the variable costs are paid, is holding perfectly steady at around 15%. They are basically arguing that they are totally indifferent to which accounting bucket the money comes from, just as long as the bottom line EBITDA continues to grow.
You know, when you lay it out like that, it actually sounds incredibly logical. In fact, it sounds like a much smarter long-term business strategy. I mean, as an investor, I would much rather see a company build genuine loyalty with a customer by giving them a great price, rather than just endlessly renting eyeballs from social media algorithms.
Conceptually, it is very logical. It is a very sound strategy. But the skepticism from the street today comes down to sustainability.
Right, because discounting is dangerous.
Very dangerous. The market is asking, is this truly sustainable, or are you just renting revenue with lower prices? Because think about the mechanics. If you eventually stop the rewards program, or if you stop subsidizing the prices, does all that revenue growth just instantly evaporate?
That is the fear.
Because when you lower your ad spend, you actually have a lot less control over your traffic. And when you lower your price, you mentally train your customer to always wait for a deal. They won't buy at full price anymore.
Yeah, you become a discount brand.
Right. So it's a much riskier lever for management to pull than just dialing up or down digital ad spend. It implies to some bearish investors that maybe your product or your brand isn't strong enough to sell itself at full margin anymore.
That makes total sense why the street is nervous.
Oh.
But let's look at the other side of the expense coin, because management has actually been incredibly disciplined there. Let's look at the SOTG&A.
Yes.
That stands for selling, operations, tech, and general and administrative expenses, basically the corporate overhead. That came in at $358 million for the quarter.
And this is actually the massive bright spot in the report. This right here is the entire operating leverage bull case for the stock.
How so?
Because they are keeping their corporate headcount completely flat. They are not hiring armies of new software engineers or middle managers. Yet, as we saw, the top-line revenue is growing at 7%.
Okay, so the revenue pie is growing, but the fixed cost of running the business is staying exactly the same.
Exactly. Which means that every single incremental dollar of new sales is flowing through to the bottom line much more efficiently because the overhead burden isn't growing alongside it. This is exactly the kind of operating leverage you desperately want to see in a mature e-commerce tech company.
It is the definition of scaling efficiently. But, and there's always a, but with this stock, we constantly circle back to that harsh GAAP reality.
We do.
The stock-based compensation and those debt costs we talked about earlier. You mentioned the convertible debt repurchase. Let's actually dig into the balance sheet for a minute because they made some pretty aggressive structural moves there that we need to unpack.
They did. And frankly, regardless of the short-term accounting loss that the market hated today, they are unequivocally making the right structural moves for the long-term health of the business.
Right. They're taking the bankruptcy risk off the table.
Totally. They have de-risked the company significantly over the last year. Their net leverage ratio is now sitting comfortably under 2.5 times.
And just for context, that leverage was at 6 times at the end of 2023.
Right. Going from 6 times to under 2.5 times is a massive, massive deleveraging effort. They are not drowning in expensive debt anymore.
Which is crucial in a world where debt isn't free anymore.
Exactly. And the way they handled this recent debt retirement is fascinating. I actually call it a stealth buyback.
A stealth buyback. Explain that to the listeners who might only trade equities and maybe don't spend a lot of time looking at convertible debt markets. Why is buying back bonds considered a stealth buyback of stock?
Well, because convertible notes are basically just equity in waiting. They are bonds that pay an interest rate, sure. But if the company's stock price goes up and crosses a certain predefined strike price, those bonds automatically convert into common shares.
And when they convert into shares, the total share count goes up.
The share count balloons and all the existing shareholders get heavily diluted. Their piece of the pie gets smaller.
So what did Wayfair do here?
Wayfair repurchased over $100 million of their 2027 convertible notes right now, while they're still just trading as debt. By stepping in and buying back those notes early, management calculates that they effectively offset over 5 million shares of potential future dilution.
Wow. 5 million shares.
Yeah, they are proactively preventing the share count from exploding a few years down the line if the stock recovers. So they are essentially shrinking the future share count while simultaneously reducing their total debt burden. It is a very smart corporate finance move.
It is really smart. And just looking at the liquidity, they ended the quarter with $1.5 billion in straight cash and nearly $2 billion in total liquidity. So, to be clear, the balance sheet itself is absolutely not the problem here.
Not at all. The fear from the street is entirely focused on cash burn going into Q1.
Because Q1 is historically their roughest cash flow quarter due to seasonality, right?
Exactly. Retailers build up massive inventory for the holiday rush in Q4. They sell it all, which is great, but then the bills for that inventory come due from the suppliers in Q1. So Wayfair always burns cash in the first quarter paying those invoices. But retail investors get incredibly nervous whenever they see total cash balances dip sequentially, even if it is a completely normal expected seasonal outflow.
Yeah, context gets lost in the headlines. So it really seems like Wayfair is a massive company in transition right now.
Very much so.
They have fixed the balance sheet. They survived the post-pandemic hangover. They have right-sized the headcount and the corporate bloat. Now, the singular focus is proving to the market that they can sustainably grow. And that brings us to the growth engine. This is the part of the deep dive where we look at their strategic initiatives, and this is where it gets really interesting for me.
They're doing some very non-traditional things for an e-commerce player.
They are. They are clearly trying to build a structural moat. And the biggest, heaviest brick in that new moat right now is the Wayfair Rewards program. Let's break this down.
This is their massive loyalty play. They launched it in the fall of 2024. And they just announced on this call that they have already crossed over 1 million paying members.
1 million members in just a few months.
Yes. And the cost of the program is $29 a year.
$29, which is such a fascinating, specific price point. It is low enough to be a complete impulse buy at checkout, but it is just high enough that the consumer feels financially invested in using it.
Right. It's completely different from, say, Amazon Prime. Prime is what, pushing $140 now?
Yes, something like that.
At $140, you might actually sit down and discuss that renewal with your spouse.
Right. You look at the budget.
Exactly. But $29.
Yeah.
That is just a, sure, why not? It covers the shipping on this rug kind of decision.
And the benefits are pretty solid for that price. Members get free shipping on everything. They get that flat 5% rewards, back-in-store credit on all purchases, and they get access to exclusive sales. But the math that management shared on the call is what really caught my attention.
The break-even math.
Yes. They explicitly stated that the entire program is financially engineered to be perfectly break-even for a customer who spends exactly $600 a year on the platform.
And here is where the behavioral psychology comes in and why this comes directly back to that margin compression discussion we were having earlier.
Walk us through the psychology.
We call this the sunk cost lock-in effect.
Okay.
Once a consumer pays that $29 upfront fee, human nature dictates that they will actively try to consolidate all their home spending to justify that initial cost.
They want to earn it back.
They desperately want to feel like they beat the system and earn their $29 back in rewards. So if they suddenly need a new area rug or a new coffee maker and they know they have a paid Wayfair membership, they are not even going to open up a new tab to check Amazon. They aren't going to drive to a West Elm.
They go straight to Wayfair.
They go directly to the Wayfair app first. It creates massive habitual loyalty.
It is literally the original Amazon Prime playbook. Just get them to pay something up front and you capture all their incremental downstream spend.
It is the exact same playbook, and the early data results are completely validating the strategy. Management said that rewards members are already driving over 15% of their total U.S. revenue.
Wow, already.
Yes. But here is the absolute killer stat from the call. Conversion rates on furniture. If you are a rewards member, your conversion rate on furniture is 3 times higher than a non-member.
3 times higher.
And for housewares, like plates and blenders, it is 3.5 times higher.
That is just a staggering metric. That means if a rewards member actually lands on a product page, they are 3 times more likely to click the buy button compared to a guest user.
It really creates an incredible flywheel effect for the business.
Yeah.
Because higher retention and higher conversion mean you don't have to constantly spend money reacquiring that same customer next year. That drastically lowers your customer acquisition cost, your CAC, over the long term.
It makes the marketing spend so much more efficient. But
here comes the skepticism from the street again.
Exactly. This exact rewards program is the primary driver of that severe gross margin pressure that the market punished today.
Because giving away 5% cash back on every single transaction is very, very expensive.
Right. You are effectively slashing your retail price by 5% forever for your absolute best, most frequent customers. So the existential question the market is demanding an answer to is the long-term lifetime value lift, the LTV lift, actually worth taking the immediate painful hit to your gross margins today?
Well, management obviously says yes. They are quite literally betting the future of the company on it. But the stock chart today, sitting down 13%, says prove it.
The market wants proof.
The market is hyper-focused on the short term right now. Institutional investors look at the cost hitting the P&L today, and they are heavily discounting the theoretical benefit that might arrive tomorrow. They're basically telling management, show me the actual cash profit right now, not just the promise of some highly loyal customer cohort in 2028.
Yeah, Wall Street is not known for its infinite patience.
Definitely not.
Okay, let's move to their second big growth strategy. And this one is actually kind of shocking for a company that spent its entire existence proudly operating as a pure-play, asset-light internet stock.
Physical retail, bricks and mortar.
Bricks and mortar.
Yeah.
They have had their first large-format test store open in Wilmette, which is just outside Chicago, for almost 2 years now.
And the data coming out of that Chicago experiment is genuinely fascinating to read.
Yeah.
Management noted that over 50% of the foot traffic walking into that store are what they call new to file.
New to file, meaning they're entirely new customers who have never bought anything from Wayfair.com before.
Never. Not once.
That is the single statistic that really stood out to me. Because in our bubble, we just assume that absolutely everyone knows what Wayfair is. We assume everyone is perfectly comfortable buying a $1,000 couch off a website based on a few JPEGs.
Okay.
But clearly, that data proves there is a massive demographic out there that simply will not buy a major piece of furniture unless they can physically sit on it first.
Exactly. It is the classic touch and feel barrier in furniture sales. And having a physical presence to break down that barrier is creating a massive halo effect for them.
A halo effect for the website.
Yes. They are seeing that in the specific geographic regions surrounding that Chicago store, they have a 30% positive spread in high-frequency purchase categories compared to their other regions that don't have a store.
Oh, that is interesting. So people go to the physical store, they sit on the couch, they trust the quality, they buy the couch, and then later they go back home, pull out their laptop, and order the throw pillows and the area rugs online because they now trust the brand.
Exactly. The store acts as a massive customer acquisition tool that drives online frequency. It is clearly working. And because it is working, they are aggressively expanding the footprint.
Yeah. They announced new large format stores coming to Atlanta and Denver. And when they say large format, they mean huge. These are roughly 150,000 square foot boxes.
Massive showrooms.
And they're also testing a new, slightly smaller format in Columbus, Ohio, which will be around 70,000 square feet.
But you have to understand, rolling out massive physical stores fundamentally changes the financial model of the entire company.
Right.
And if there is one thing Wall Street analysts truly hate, it is when a company changes the model and breaks their perfectly tuned Excel spreadsheets.
It totally screws up the comps.
It does. Because physical stores have a completely different P&L structure than a website.
Break that down for us. why does a store ruin an e-commerce analyst's model?
Well, a physical store naturally has a much higher gross margin profile.
Higher gross margin. Why?
Because think about the logistics. If you walk into a store, buy a lamp, put it in the trunk of your car, and drive it home yourself, Wayfair does not have to pay FedEx or UPS to ship that item to your house.
Ah, right. No outbound shipping cost immediately boosts the gross margin.
Exactly. That sounds great on paper. However, physical stores come with massively higher operating expenses, the OPEX.
Rent.
Rent is huge. You have to pay commercial rent on 150,000 square feet. You have to pay the massive electricity bills to keep it lit. You have to pay an entire staff of sales associates on the floor. You have to pay for the giant illuminated sign out front.
So it completely muddies the waters financially.
It shifts massive amounts of cost out of the variable COGS bucket and dumps it right into the fixed OPEX bucket. It makes the company's financial statements significantly harder to read and predict for a traditional pure-play e-commerce analyst.
It changes the whole risk profile. But having said all that, there is one very specific detail about their retail strategy that I think is absolutely brilliant. It is a uniquely Wayfair approach.
The inventory model.
The inventory model. Explain this, because it blew my mind when I read the transcript. If I walk into that new Atlanta store when it opens and I see a beautiful leather couch sitting there on the floor, Wayfair didn't actually buy that couch.
Correct. They do not own the vast majority of the inventory sitting in those stores. It operates on a consignment-style model.
That is why.
The underlying suppliers, the actual factories and manufacturers of the furniture, they technically retain ownership of that physical inventory right up until the exact moment you, the customer, scan it at the cash register.
That is incredible capital efficiency. So Wayfair essentially takes zero working capital risk on the floor stock.
Very little risk. If a certain style of couch turns out to be a total dud and nobody buys it, it is ultimately the supplier's problem to deal with, not Wayfair's. Wayfair isn't stuck holding the bag on millions of dollars of dead seasonal inventory.
That allows them to fill a giant 150,000 square foot showroom with thousands of beautiful products without having to tie up hundreds of millions of dollars of their own cash just to buy the stock up front.
It is a massive structural advantage that traditional heritage retailers like a Crate and Barrel or a Restoration Hardware generally don't have. Those legacy guys usually have to commit to buying and owning the inventory up front before they display it.
That is a game changer if they can successfully scale it. It essentially turns the physical store into an offline marketplace. It's almost like they built an Airbnb for retail furniture space.
It is exactly like that. But again, the street's problem is timeline. It takes years to scale physical retail. Having 2 or 3 successful stores open today simply does not move the needle enough on a $12 billion revenue base to justify a higher multiple right now.
It's planting seeds that won't become fruit-bearing trees for at least 5 years.
Investors want fruit today.
Okay, let's hit strategy number 3, AI and tech efficiency. Look, every single tech CEO is required by law to talk about AI on their earnings call right now.
It's mandatory.
It is. But Niraj Shah, the CEO, talked about what he called the holy trinity of AI impact. He claims that their internal AI deployment is simultaneously improving quality, speed, and cost.
Which is a bold claim because usually in traditional project management, you only get to pick 2.
Right. Fast, good, or cheap. Pick 2.
Exactly. But Niraj is claiming that AI gives them all 3 at once.
Is this just corporate buzzword bingo, though? I mean, we hear these vague AI promises everywhere. Is there actually something fundamentally real happening here at Wayfair?
I am usually the absolute first person to call out AI buzzword bingo on these calls.
Oh, I know you are.
But in this specific case, the hard financial data actually supports his claim. Just look at the headcount metrics we discussed earlier.
The flat SOTG&A.
Right. They successfully grew top-line revenue by 7%. They processed more physical orders, they handled a higher volume of customer service inquiries, and they did all of that without adding net new headcount to the corporate roster.
They grew output without growing input.
Exactly. That strongly suggests that their internal AI tools, whether that is coding co-pilots, making their software engineers faster, or automated customer service bots resolving returns without human intervention, those tools are actually working as advertised. They are definitively doing more work with the exact same amount of human capital. That is real, measurable productivity.
They also mentioned some external-facing AI partnerships, specifically talking about agentic search integrations with Google and Pinterest.
That is mostly a defensive moat strategy. They want to ensure that in the near future, if a consumer opens up an AI assistant and says, hey, find me a mid-century modern coffee table under $300, the AI engine prioritizes serving up a Wayfair product link instead of an Amazon link.
They are trying to embed themselves into the fabric of future search behaviors before the landscape completely shifts.
It's smart, proactive management, but honestly, it is basically table stakes for any major e-commerce player at this point.
Right. So taking a step back, we have a company here that is clearly innovating. They have the rewards program firing, they're building a unique physical retail model, and they are leveraging AI for real internal efficiency. They are actively growing revenue while their market shrinks. But despite all of that, the stock is just getting hammered today. We need to place all this company-specific data into the broader macroeconomic context.
The macro is the wet blanket suffocating everything in this sector right now.
It really is. We are in the middle of a prolonged category contraction. As we said, the entire home furnishings market is down in the low single digits.
And this ties directly, fundamentally, back to the state of the U.S. housing market.
Because nobody is moving.
Nobody is moving. Existing home sales are basically frozen solid because absolutely nobody wants to voluntarily give up their existing 3% mortgage rate.
We call it the golden handcuffs.
The golden handcuffs. If you are sitting on a house with a 3% mortgage and current market rates are hovering at 6 or 7%, you are simply not moving to a new house unless a major life event forces you to.
And moving is historically the single biggest trigger for buying new furniture.
It is the absolute catalyst. You buy a new house, you realize your old couch doesn't fit the new living room, you buy a new couch. If you don't move, you buy significantly less stuff. Wayfair is basically fighting macroeconomic gravity right now.
Which honestly makes their 7% growth look even more impressive. The fact that they are growing at all while the total addressable market shrinks completely confirms the share capture thesis.
They are taking share. They are absolutely eating the lunch of the smaller, highly fragmented players.
The local mom-and-pop furniture stores.
The mom-and-pops, but also the smaller second-tier e-commerce sites that simply cannot afford to subsidize fast national logistics or outspend Wayfair on digital ads. Those smaller players are dying off, and Wayfair is sweeping up their volume.
Now, management made a very strong, very deliberate statement regarding the housing market on the call. They explicitly stated that they do not need a miraculous housing market recovery in order to keep growing. They are intentionally underwriting their business for a prolonged, slow-burn macro environment.
Which is very smart expectation setting. You don't want to promise Wall Street a macro recovery that you can't control.
Right.
But their commentary also really highlighted the K-shaped nature of the current consumer recovery.
The K-shape, right, the divergence.
Yes. They specifically called out that Perigold, which is their high-end luxury catalog brand, is absolutely flying right now.
So the wealthy are doing just fine.
The wealthy are doing great. They are still happily buying $5,000 custom sofas. They aren't really affected by mortgage rates or grocery inflation. But the mass market, which is the core bread-and-butter Wayfair.com customer, they're incredibly value conscious right now.
They are still buying, but they absolutely demand a deal before they check out.
They need a deal. They need a psychological win. And that brings us right back full circle to exactly why the stock sold off today.
The margins?
The margins. The customer demands a deal. Wayfair is capitulating and giving them that deal through the rewards program and lower pricing. That inherently hurts gross margins. But the institutional market wants profitable growth right now.
Not eventually. Now.
Wayfair is offering them top-line growth, accompanied by a vague promise of future profit leverage. And investors are just completely exhausted by the investment phase.
They have heard, we're investing for future growth on tech calls for 5 straight years.
Exactly. And they have watched the Wayfair stock chart go from $300 a share during the pandemic down to $30, now back to $80. They are scarred. They want the real GAAP earnings to finally match the theoretical adjusted EBITDA.
Until those 2 lines on the chart converge.
Until the 2 sets of books become one clean set of books, this stock is going to remain trapped in the penalty box.
So, to sum up the dynamic here, we basically have a massive disconnect between a seasoned management team that is playing the long game building structural moats, capturing market share, ignoring short-term margin noise, and a public market that is demanding immediate GAAP profitable gratification.
That is the perfect summary of the day. It is a fundamental timeline conflict. Management is thinking in multi-year horizons. The market is trading based on the next 90 days.
And right now, the market holds all the voting slips.
They do.
All right. We have thoroughly dissected the numbers, we have analyzed the strategic pivot, and we have diagnosed exactly why the market is feeling nauseous today. Now, it is time for the segment that our compliance lawyers absolutely love to hate.
Oh boy, the part where we get dangerous.
Exactly. This is not financial advice segment.
Disclaimer time, everyone. Listen closely. We are just two disembodied voices in your headphones. We are absolutely not your financial advisors. Do not execute trades based on what you are about to hear. This segment is strictly for educational and entertainment purposes only. If you lose your shirt, do not tweet at us.
We are just brainstorming wild, hypothetical ideas based on the data points we just discussed.
But, if you happen to make a fortune, feel free to send a bottle of something very nice to the studio.
I prefer scotch. Okay, the premise for this trade idea is pretty simple. The market has severely, perhaps overly, punished Wayfair's equity today for margin compression. They clearly think Wayfair is giving away the store just to buy top-line growth. Meanwhile, the company itself is actively, aggressively buying back its own convertible debt, which effectively acts as a signal that management thinks their own equity is undervalued long-term.
Okay, I see where you are going. And you have a specific structural trade idea based on this divergence.
I do. I am officially calling this trade the suburban bunker spread.
The suburban bunker spread. Okay, walk me through the logic.
Here is the logic. Wayfair is betting the house on physical retail expansion in very specific, growing, mid-tier cities. They are targeting Atlanta. They are targeting Denver, Columbus.
Right.
And at the exact same time, they are locking those regional customers into a $29 loyalty subscription. So conceptually, Wayfair is effectively shorting the idea of Americans moving to new houses, and they are going heavily long on the idea of Americans nesting in their current houses.
Okay, nesting, renovation without relocation.
Precisely, renovation without relocation.
Yeah.
The macro thesis here is that absolutely no one is moving anytime soon because interest rates are locked and housing inventory is dead. Everyone is staying put.
Yeah.
They are financially trapped inside their 3% mortgage bunkers.
Right.
But humans get bored. If they are trapped in that bunker, they eventually get sick of looking at their surroundings. They start to hate their old kitchen cabinets. They despise their worn-out living room couch. So if they have to stay put, they decide to remodel the space they have. And Wayfair is perfectly positioned as the primary player winning on this specific behavioral trend of upgrading in place.
Okay, I follow the behavioral logic. So what is the actual trade structure? How do you play the spread?
It is a pair trade. For the long leg, you go aggressively long Wayfair, ticker W, but you do it via LAPS.
Long-term equity anticipation securities.
Exactly. You want to buy deep-in-the-money call options expiring in 2027. You want to perfectly align your investment time frame with the exact same 2027 convertible notes that management just bought back.
So you are co-investing alongside management's timeline.
Right. You are betting that this retail and reward strategy actually works and compounds over an 18 to 24-month horizon. You are buying the sheer panic dip today while the street is puking the stock.
Okay, so that is the aggressive long leg. That is the bullish bet on the company. But it's a spread. What is the hedge? What is the short leg?
For the hedge, you short a curated basket of moving supply companies.
Leaving supply companies.
Yes. You heavily short U-Haul, ticker UAL. And you also short the major cardboard box manufacturers, companies like International Paper, ticker IP, or Packaging Corporation of America, ticker PKG.
That is wildly specific. Shorting cardboard boxes as a hedge against furniture.
Think about the mechanics of the macro. If my thesis is right and absolutely nobody is moving out of their house, U-Haul truck utilization completely plummets. Residential cardboard moving box sales drop to zero. Local moving companies start going bust.
Okay.
But Wayfair's revenue continues to climb because those exact same trapped people are upgrading the house they're stuck inside.
So you are structurally hedging the underlying housing market liquidity.
Exactly. If the housing market stays frozen solid, the Wayfair nesting thesis wins and the U-Haul moving thesis loses. But conversely, if the housing market suddenly explodes, say the Fed drops rates to zero and everyone starts moving across the country, Wayfair might actually lose market share as people go to local physical stores in their new cities, but your U-Haul short gets squeezed as moving demand skyrockets, covering your downside. It is a perfectly balanced macro hedge.
That is.
Yeah.
Wow. And what is the primary catalyst that makes the long side pop?
The kicker is that Chicago store data. If that 50% new customer acquisition rate they saw in Chicago holds up when they open the massive new showrooms in Atlanta and Denver, the overall top-line revenue reacceleration will be mathematically undeniable.
And then the shorts get trapped.
You will see a violent short squeeze on the equity. Right now, it's getting priced like it's heading for restructuring at $79. If they mathematically prove the omnichannel model works in multiple geographies, Wayfair is a $150 stock easily.
It's a fascinating setup. But what is the fatal risk factor here?
The ultimate risk is that the U.S. consumer just totally, completely taps out. If we hit a hard, deep recession and unemployment spikes, people stop buying anything. They stop buying food, let alone a new patio set. If that happens, you lose absolutely everything on those Wayfair leapies.
Right. And ironically, the box manufacturers might actually be okay in that scenario because consumer staples still need cardboard boxes to ship groceries.
Exactly. The hedge might not save you from a total consumer collapse. But look, that is exactly why we call these high-risk conceptual trades.
It is outrageous. It is the ultimate bunker bet. I kind of love the pure logic of it, even if the actual execution terrifies me. It is fundamentally betting on the American consumer being financially stuck, but incredibly bored with their living room.
It is the suburban bunker spread. You heard it here first, folks.
Seriously, though, please do not actually put this trade on in your PA. But if you do paper trade it, good luck.
All right, let us wrap this deep dive up with a quick recap. Wayfair Q4, we had a solid revenue beat at $3.34 billion. Adjusted EBITDA literally doubled year over year. But it was completely overshadowed by a massive GAAP miss of negative 89 cents per share.
And the market reaction was swift. A 13% haircut today. Investors clearly panicked over the management's conscious choice to increase investment spending, which directly impacts near-term gross margins. The street is demanding to see clean, straightforward GAAP profits, not these complicated, highly adjusted metrics.
The key takeaway from the entire print. The company is effectively aggressively buying market share right now through margin investment. They are utilizing the rewards program and strategic pricing. They are actively pivoting dollars away from digital ad spend and funneling it directly into customer benefits. They are attempting to build a long-term structural moat in a world where the overall category is contracting.
Right. Management keeps saying the word compounding. The market is just screaming, show me the actual money.
So Q1 is going to be the ultimate proving ground. If we see gross margins slip below that 30% threshold without a massive corresponding spike in top-line revenue, the penalty box to this stock is going to get much smaller and much tighter.
But if that rewards flywheel actually starts spinning the way they model it, watch out on the upside.
It is going to be an incredibly volatile year for the W ticker. Buckle up. Thank you all for listening to Talk Tickers.
Here's a final provocative thought for you to mull over before we go. If Wayfair's consignment inventory model actually scales perfectly across 50 giant retail stores, do they even remain a furniture retailer, or do they functionally become the world's most profitable commercial real estate landlord for foreign furniture manufacturers? Think about how that changes the valuation multiple.
That is a fascinating angle. We will be back next time with another deep dive into the prints that move the needle. Until then, keep your eyes on the tape.
Stay sharp out there.